Derek, perhaps let's start off with you, because sentiment and confidence levels certainly not looking good at this stage of the game within the retail sector, and vastly different to what we saw in the fourth quarter of last year.
I think that's absolutely right. So the 3-year high of recent times was recorded in the fourth quarter of 2010, and since then the index has dropped or slumped notably. So at that point in time, the index level was at 63, and it's dropped just below the 50 level at 47 for the second quarter of 2011.
So what's shifted? Is it simply the fact that we're not in a festive season?
I don't think so, because the survey measures the same time in the previous year. So this doesn't ask the respondent to have a view on this quarter relative to last quarter. So it, strictly speaking, compares like for like. So I think there are two sectors that are probably the biggest contributors to that slump, and that would be the durables and the non-durables. The semi-durable sector, I think, has actually rebounded quite nicely off quite an unexpected slump that they had registered in the first quarter of 2011.
Danie, is this what you're seeing coming out of the retailers? Because of course we know those durables and semi-durables did very good ahead of the Soccer World Cup last year. Are you seeing them starting to go into tougher times? Because we're still seeing pretty good results coming out of our clothing retailers.
Yeah, I mean, you touched on an interesting point. I mean, there's a lot of distinction between different subcategories, and even between the listed retailers and unlisted retailers out there. So if you're asking specifically about durables, those are categories that over the course of the last year have seen severe price deflation for a lot of the retailers. And running into the World Cup and even the back end of last year, there was tremendous volume growth still, but all the retailers had to run just that much harder just to stand still because prices were falling as quickly as they had. Now, I think talking about this current year, a lot of the retailers would have hoped for a little bit of a return to pricing power, a little bit of inflation in those categories. But because the rand has remained so strong, they haven't seen that come through. So if you're talking about those kinds of categories, we're still sitting in many cases, quite steep price deflation, which just makes it that much harder for retailers to run it at the same rate at which they were 12 months ago.
Of course, that strength in the rand is a double-edged sword here, because you're looking at those that do import possibly benefiting from the fact that those prices will be coming in lower.
Yeah, I mean, from a consumer standpoint, you're absolutely benefiting. From the retailer standpoint, the rand value of what they're selling has fallen. So they
just because that pricing power has diminished.
Exactly. So there's been a pretty clean pass through to consumers of most of the benefit of the strong rand and the underlying price deflation, if you think about categories like flat screen TVs. So that's just made it a little bit more difficult for some of the retailers in those categories to maintain the top line growth rate.
Derek, to what extent do you think that the drop in business confidence among retailers is reflective of consumer sentiment at this stage, and very, very high debt burdens at this point as well?
We're certainly still struggling with the overhang of the debt burden. I think there are a number of other factors. At the end of 2010, there was real wage increases, which were quite reasonable at that point in time, but also disproportionately favouring a part of our working population which had a job in any case. The real wage growth, we think, will be absent in the second half of this year, or at least not as spectacular as it was last year. And of course, the lack of job creation, which again favours that part of the population that don't have a job to start off with, has certainly not come through in a big way to help. So those would be two big factors. I think that the third factor that weighs down is interest rate expectations for the remainder of this year, but probably most direct and most importantly is just an increase in commodities, which give rise to the non-durable goods sector experiencing a significant price push. And then lastly, some administrative prices. We think about fuel, electricity, and then transport-related costs, which I don't think we've seen yet, but certainly will experience in the next 6 months, some way or the other.
Danie, what does this scenario spell, or how does it translate for food retailers operating within this context?
Yeah, look, it's still quite difficult, and it's not a uniform answer for all of the food retailers. One of the things that we've seen over the course of the last year is some pretty significant shifts in market share. Shoprite, and particularly the Checkers format, taking quite a lot of market share away from the likes of Pick n Pay. But at a category level, the thing that's still missing for the food retailers is inflation. You spoke about things like electricity prices, administered prices, pushing through the cost base, the retailers really do need to be able to pass on most of those cost increases to their customers in order to maintain their own profitability. So what we're seeing now is that even in the absence of sharp underlying commodity price moves, we're starting to see a little bit more inflation creeping into that food basket as the retailers start to recover some of those cost pressures.
Is this a trend, do you think, Derek, that we're going to see continuing for this year? And of course, you mentioned interest rates. There is an expectation we could see either in the fourth quarter of this year or the first quarter of next year, that first rate hike in the cycle.
I think one of the big problems is that there's no consumer demand to price into. So you have lackluster consumer demand with increasing prices.
Which could just get worse.
Which could just get worse. And unfortunately, some of the fairy dust that you need to motivate a case for a price increase is just not there. And I guess now you start playing the market share game. We all know it's a zero-sum game where one is just stealing from the other for the moment. But on an overall level, the size of the pie is not growing. And I think that's the biggest issue that most of the retailers are struggling with.
Entering the fray, to take a nibble or a bite out of this pie that's staying the same size, Danie, is the fact that we've got Walmart entering. So how do you see this changing that playing field?
Yeah, I mean, look, obviously the world's largest retailer entering the market is going to lead to some changes. Our sense is that the near-term changes is likely to be relatively small and maybe confined to one or two specific categories. Massmart have said that they want to be aggressive in rolling out their food retail business, and presumably Walmart's strength in sourcing in food and even in non-durable categories could lead to some pricing pressure across the market. But I think really the story in the market right now, more so than Walmart entering, is the distinction that we're seeing between the listed retailers and some of their unlisted peers. If you talk about a category like clothing, numbers coming out of the likes of Mr. Price, Foschini, Woolworths, very strong still. Now, much of that is due to market share gains from the Etcon group, which is private, it's unlisted, but it's a third of the market. And those kinds of market share shifts, I think, benefiting the listed retailers at the expense of the unlisted guys, and particularly some of the smaller subscale players as well.
So competition getting tougher, Derek, but at the same time we see some retailers coming back to markets. So news that Whole Sports, which used to be More Sports, relisting on the JSE, and a couple of other companies such as Busby also looking at potential listings. A good environment for that, do you think?
I guess it depends on, I'm not a commentator on the pricing game, but I guess it's much easier, to come to the market with a growth story which underpins a large part of what's almost common acceptance. It's not a case of if we believe in growth, it's a case of when. And if you time your entry onto the market properly, I guess you have to benefit from that purely if you just look at the share price, which is obviously reflective not of the past, but of the future dreams and future ambitions of a company. In
terms of investor appeal, Danie, what are they catering to? Because we know when it comes to the retail segment, it's the foreign investor market that's really been driving those prices up.
Yeah, I mean, a lot of the positive re-rating we've seen in the share price has been driven by foreign interest in the market. If you talk about the sporting industry as a whole, there are a couple of players of size and scale in that industry other than Whole Sport. You've got Foschini with their Total Sports business, Mr. Price recently launching their own sporting goods business. So it's a category that has become a little bit more competitive in the last few years. Talking about categories where Walmart could potentially have a big impact in the market, importing technical sporting equipment is one category where that global sourcing power and scale you could have an impact on pricing at that end of the market. So I think it's possibly a good time to seek a listing or an exit if you're a private equity investor in an investment such as this, but it's not necessarily the most attractive end of the market looking over the next 3 to 5 years.